The government's right to warn of risk to the economic outlook. We could see a significant fall for the sterling. Michael Pearce, Capital Economics. This week we will have speeches from the ECB and a Euro financial stability review. How significant will this data be for the Euro interest rate?
I think the Eurozone officials are in a wait-and-see mode. They'll be ready to emphasise that they can do more to support the economic recovery, but they'll also continue to stress that existing measures will need time to work their way through the system. We're unlikely to see anything that will move the markets this week. We think they will need to do more eventually. We're penciling in another extension of the QE programme until September 2017. But the ECB is clearly running up against the limits of what it's comfortable with doing. So I think the risk is that the ECB ends up not doing enough to push inflation back to target.
New home sales and pending home sales in the USA are out this week. What should we expect from this information?
Well, I think with the housing data, it's always difficult to interpret month to month because the numbers are so volatile. This month, we're expecting new home sales to be broadly unchanged from last month. We've had the home builder sentiments been slightly weaker, and we've had unusually cold weather in the northeast, which might dampen the trend. But I think the overall trend is towards stronger home sales in the US. And that's just one more example of how the US economy is getting back to normal. The housing market's very tight. I think that is one factor that leads through to our forecast that actually core inflation's rising and could be well above the Fed's 2% target next year, which should in turn push them to raise rates faster than the markets are currently expecting.
There are fears the UK will head into recession if they leave the EU. What's backing these fears, and will the UK GDP year-on-year release show any signs that the country is heading down the path of recession?
Well, the UK GDP release will just be the second release of what we already know, which is that the economy slowed in the first quarter. I think the Treasury report out this morning showing a hit to GDP of around 3-4% over the next 2 years as a result of Brexit. Kind of on the pessimistic side, we're expecting if the UK does vote to leave on the 23rd of June that there'd be perhaps 1% or so slower growth over the next 2 years. By the way, I think fears that Brexit might lead to higher interest rates are wide of the mark. I think it's much more likely that the Bank of England would leave rates lower for longer, or maybe even cut rates if there were a significant hit to the economy. Bigger risk for the UK rate outlook is actually that if we vote to remain, the economy picks up a little bit, could actually see a rate rise come back on the agenda before the end of the year. I think that's something that the gilt markets are not pricing in at the moment. The government's right to warn of risks to the economic outlook. We've seen from the market there is some pricing in of a Brexit risk in sterling, so I think we could see quite a significant fall in sterling if we were to leave. And there would be a period of uncertainty that would dent business investment. It's undoubtable that there would be a short-term costs, but obviously it's in everyone's interest to negotiate a comprehensive trade deal fairly quickly along the kind of lines of the status quo. Fears that there could be some major hit to activity, I think, are wide of the mark.
Thank you, Michael, for your time today. Stay with us this week for exclusive interviews, currency forecasts and outlooks on commodities. But for now, goodbye.